Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. So today I'm joined with Marco Santarelli. How are you doing today, Marco?
Kirk, I'm doing great. How are you?
Doing great. Doing great. You're one of our two Pete's. You've been on the show before and trying to bring back some of my favorite guests to talk about some of my favorite topics. But for those of you who didn't hear the prior episode with Marco, tell us a bit about your background.
My background, well, I just refer to myself as a serial entrepreneur. I've been involved with, small businesses and launching various business ventures over the years, and now I focus primarily on real estate investing, but an eclectic mix of other investments, including e-commerce, Broadway productions, Broadway musicals, co-producing about 12 or 13 right now. Um, Run a small investment fund and a few masterminds, large, educational masterminds. So I'm involved in everything. But the thing I've pretty much been involved in the longest, Kirk, and kind of what I've been known for is just kind of really launching and pushing hard the whole turnkey investment real estate product and space, 1 to 4 unit properties. I started that about, oh man, what was it? 2004, so 20 years ago, a little over 20 years ago. And it's been a successful business, and we continue to sell hundreds and hundreds of properties every year to investors by providing them that complete turnkey investment experience. But anyway, I'm trying to answer your question in a very short period of time. There's just a lot there. I think there's a lot of depth.
That's
So
all right. We'll get into the weeds a little bit. It's a good
yeah.
start anyway. Um, so you came on before to talk about passive real estate investing and turnkey real estate investing. Um, let's start out just kind of talking about because I part of the reason I want to bring you back on the show is we took a little hiatus on the show to talk from talking about real estate for a while because real estate rates, interest rates went up and it got a lot more expensive. And to me, it just seemed very unattractive. So I wasn't interested in bringing people on to talk about stuff that I intellectually just wasn't feeling it. But as rates start to drop, the opportunities start to look more attractive. So I wanted to bring you on. So what are you seeing in the real estate market right now? Like, how does it look to you at the moment?
Well, it's going to sound biased, but I'm always bullish on real estate, and I can explain why. First of all, you mentioned mortgage rates. Well, you said interest rates, but if you're talking about mortgage rates, which is a major lever in how people um, jump in or jump out of the real estate market, because if rates go up, things become less affordable from a home ownership perspective. But from an investor's perspective, if mortgage rates are going up, their debt service goes up, which means that investing in real estate typically means lower cash flows. And a lot of investors want to invest in real estate for the cash flow. So if they're losing on the cash flow side, they tend to pause and wait to see what rates do. If you go back 30 years and look at a 30-year fixed rate mortgage, it averages, historically speaking, 7.7%. If you look at where rates are today, mortgage rates, they're in the low sevens. Depending on credit, the size of the loan, the location, that's going to fluctuate. It could even drop below 7%. Interestingly enough, mortgage rates actually have been going up over the last week or so. In fact, I just got another notification this morning that rates bumped up again, about 0.125%. So small changes, small fluctuations, but long story short, mortgage rates are still, historically speaking, very attractive. Investment in real estate still makes sense. You can invest in real estate, protect your wealth, grow your wealth, create cash flow, and have the tax benefits and the leverage that comes along with it. This is why I'm always bullish on it. A kind of a side comment to that, which is really a conversation in and of itself, is like when people ask me, is now a good time to invest in real estate? I always tell them, look, it's not a question of when to invest, it's a question of where to invest. There are always opportunities out there. It's just a question of what market and submarket are you investing in. Um, if you're in the tier one markets, New York, Los Angeles, San Francisco, very expensive markets, the numbers don't make sense. I mean, they haven't for a very long time. But there are many, many, many markets around the country where it makes sense to invest. So, long answer to your question, but rates have been pretty consistent. They're expected to come down, even though they've been bumping up recently, which will make interest in real estate go up, demand for investment real estate increase from where it is right now, which is an issue. just because demand is so strong. But I've always been bullish on real estate. There's always opportunity. We always work with investors that are investing around the country in different markets that we, come in and out of. So I think there's a lot of meat on that bone there to kind of chew on, Kirk.
Yeah, no, no, for sure. And yeah, to be clear, I was talking about mortgage rates, but just rates in general. And I think, if you look at inflation was high and then came down, and the Fed was trying to attack it with higher rates, which bumped. So here's the challenge I faced, right? So we had, for whatever it was, 15 years, we had interest rates at close to zero, right? Mortgage rates were in the threes, some even got in the twos. Um, and then all of a sudden it bumped up to 7.5, and even went up to 8 at one point. Now that's double the monthly payments. So you'd have not only double the monthly payments on the mortgages, but also property prices went up like 20 to 60% on top of that. So not only was it was expensive before, but it's so much more expensive now. And so I've always struggled with and maybe it's because I'm in a tier one market, I've always struggled with the numbers don't make sense. You can't buy something for appreciation, you buy it for cash flow, as you know. So how do you look at that? Like, where should people be looking? How should they be thinking about real estate when everything around them is expensive? I mean, maybe historically not expensive from the mortgage rates, but recently in the last 15 years, which the prices are tied to, is somewhat expensive.
So when rates went down and mortgage rates went down, affordability went up. Whether you're a homeowner looking for a second home or you're looking for investment property, that boosted demand, and that demand created excessive pressure on the markets all around the country. We talk about, the real estate market as this one blob, in the US, and there's one real estate market, but the reality is there's no such thing as a housing market or real estate market. We have to talk about it granular. There are over 500 metropolitan statistical areas around the country. And so when you talk about real estate, you got to ask the question, well, where specifically are we talking about? What market, what sub-market, even down to the neighborhood level. But when interest rates went down, mortgage rates went down, it boosted demand and it created a larger problem to the problem we already have. The problem we had, and for many, many years, is we have excessive demand and undersupply. Currently, we are underbuilt by 2.1 million housing units right now this year in 2024. And that is a problem because that's pent up demand. And even though that is slowly correcting itself, the pace of that undersupply is correcting itself, we still have 2.1 million units less than what we actually need in terms of existing demand, organic, which factors in organic growth and whatnot. So depending on what side of the fence you're on determines like how you look at this problem. If you are trying to get into the market as a homeowner, you're going to be paying higher prices, relatively speaking, to the past because prices have gone up because there's just been liquidity with low mortgage rates, like you mentioned, 3.5, 4% rates. Even though rates are higher now, it's slowed down. It's actually cooled the market off, but the demand is still there. We have more demand than supply. That problem is slowly getting fixed, but it's going to take many, many years. In fact, a couple of years ago, the prediction was the trajectory is that we would normalize in 2030. We would reach a form of equilibrium in 2030. That's not happening. Right now, we're looking at beyond 2030 before we're going to see a normalization of supply and demand. So if you're a real estate investor, you're thinking about investing in real estate, or you are looking to expand your portfolio, you have to start asking the question of where do I invest, not when do I invest? Because if you've got the investable capital and you're ready to deploy that and get into the real estate market and basically get on the equity train, you have to ask the question, where do I invest? Because the deals are out there, regardless of whether mortgage rates are at 3%, 7%, or 18% like they once were in the early 1970s. People were still buying real estate when interest rates were that high. So you just have to run the numbers. You have to look at the location, do your due diligence, pick the right markets, and make sure the numbers make sense. Math is the core factor here when it comes to doing your analysis with real estate. If the numbers pencil out, then it's potentially a good deal. So again, a long answer to your short question, should you invest? If it makes sense for you, yes. Where do you invest? Well, that's another question. Are mortgage rates too high? Mortgage rates are always a relative question. interest rates and mortgage rates, is it too high? Well, compared to what? Last year, 10 years ago, 20 years ago? It's really a math problem. If the numbers make sense, the location makes sense and everything, all the boxes are checked, it's probably a deal worth considering. So, Kirk, I don't know if I answered your question. Maybe I've just dumped on a lot on that, but
No, no, it's fine. I think you did. I mean, so obviously it's location centric. What are some interesting locations to look at? I mean, well, there's two parts to this. The first part, to kind of go back to your point, was when you say it's underbuilt by 2.1 million. I know everyone kind of touts these numbers, but I'm just thinking about it logically. What does that actually mean? Does that mean people don't have a house? Like what? Because if people aren't living in a house, then they're living in a rental. If they're living in a rental, then that'll be empty if they live in the house. So what does it mean to be underbuilt by 1.2 million? Because to me, that just seems like there aren't caravans of people who are unhoused. So what does that mean in a realistic sense?
what that means is that the market that's out there, the market for purchase numbers in 2.1 million households. That simply means that there are people out there that can buy, could buy, want to buy, that are either living at home, living with their parents, bunking up with, two or more uh, income earners that could be living separately. And I'm not talking about married couples, but people who are actually living together that can separate and take up another household unit, a housing unit. So that's all it means and that includes the for sale inventory and the for rent inventory potential. But if you were to just take everybody in this country looking for a piece of real estate, like a residential real estate, in any category, investment, rental, or homeowner, there's enough demand out there to fill 2.1 million more doors. 2.1 million more doors. That's all that means. So if we today waved the magic wand and created that 2.1 million, and of course, assuming they, qualify for financing, we could fill that void. We could fill the 2.1 million units. Now that number changes year over year. It's been actually increasing. The curve of that trend has been slowing down because builders have been building as fast as they can, especially in the Southeast, but in places all over the country to create that inventory to fill that demand because they know the demand is there. There's market research done and analysis every single month. Builders are polled, homeowners are polled, real estate agents are polled. There's a lot of data that's collected because it's housing. It makes up almost a third of our economy. So there's a lot of analysis that's done in this space. And these numbers have been around for many, many years. They change quarter by quarter by quarter, but the trend since 2014 has been negative, meaning that we have been underbuilt since 2014.
Okay. Yeah, that makes sense. No, I appreciate the explanation. That's very helpful. Um, so all right, so getting back to my other question is where should people be thinking about investing? I mean, what markets do you like now if you were looking in any market?
Um, so with our company, we have a footprint in about 20 markets or so, mostly on the eastern half, predominantly on the eastern half of the United States, because that's where just the inventory is available. The numbers make sense. We've got our teams on the ground. But when we're working with clients, the top markets are predominantly Memphis, Tennessee, the Memphis metro area, Kansas City, Missouri, Indianapolis, Indiana, um, multiple markets in Florida, from Jacksonville down to Orlando, Daytona. Southwest Florida has multiple markets, Ocala, Palm Bay. So Florida is actually, just one of those states where there's so much growth and demand and in migration that it makes sense. Now prices have gone up, quite a bit over the last few years, actually several years since 2020, just around COVID, the beginning of COVID. But Florida's still a very, very popular state. The numbers don't make as much sense from a cash flow perspective, but it's still a very strong long-term play. Other markets, those are our primary markets. Yeah, Indianapolis, Kansas City, the Memphis metro area, and multiple markets around Florida. That's where investors are looking at pretty heavily right now. Where they're not necessarily looking at is what I called the tier one markets before. The major metro areas where prices are very expensive, parts of New York, Southern California, Northern California, um, Washington, D.C. When you're talking about properties that are five, six, seven, $800,000 for a single family home, the numbers really don't make sense. You can't rent that property for enough to really cover your expenses and your debt service and have positive cash flow unless you come in with a large down payment. So they don't make sense from a cash flow perspective. Can they make sense from an equity perspective? Well, as long as you're not being a speculator, meaning you're gambling, you typically don't want to be investing in those markets because you're speculating, you're now banking on equity continuing to grow through appreciation, meaning just organic price growth year over year, not the pay down of your mortgage. That is somewhat predictable because you can follow trends, but the thing is you can't completely bank on equity growth because now you're just investing for appreciation, not for cash flow. It's good to have both. Really, the best real estate investment is one that gives you both. So again, long answer to your question, but those are the markets that are pretty popular right now with us as far as inventory.
Okay, great. No, I like some of those markets. Well, let me ask you this, because there's obviously different kinds of real estate for different markets. Are there different types of real estates that are doing well now as a, single family, multifamily, commercial? Like what do you feel like are the best opportunity sets for real estate type?
Well, commercial, generally speaking, has been struggling. Industrial has been doing well because of just the manufacturing and the economy in general. Excuse me. But commercial has been suffering. Vacancy rates, leases, you know, uh, have increased. Residential doing well for the reasons we just talked about. There's strong demand. Builders can't keep up. There's not a lot in the resale market. Even real estate agents are having a hard time finding listing inventory when they do have listing inventory. If it's priced well, it will often sell very quickly, sometimes multiple offers depending on the market. So residential is doing really well. Industrial is doing well. Commercial struggling. Apartment buildings have softened. The apartment, like what we call large scale real estate, residential real estate. That's been struggling somewhat this year. My favorite, again, it's going to come across as being a little bit biased, is really the small scale residential space, which means 1 to 4 unit properties from single families up to fourplexes. And the reason for that is they're understandable, they're relatively speaking abundant, they're easy to finance, they have the best terms in terms of financing because you can get conventional loans, conventional financing, which offers the best rates and terms out there. Um, but my focus has been residential all along. I've looked at commercial and I've just never ventured down that road. It requires a different skill set and a team that you build around you. So, but yeah, and in terms of appreciation, you kind of touched on this, Kirk. Right now, um, nationally speaking, and I don't like talking always in terms of, the housing market on a national basis, but the housing market on a national basis has been right around 5%. So if you look at year over year percent change in prices or value, property values, it's been increasing about 5% per year overall. Where we're seeing the largest growth right now is in Southern California and Southern Florida. Southern California is averaging about 8% per year. Southern Florida is about 7% per year. If you look at the Northeast, as far as that quadrant or region of the US, 6%. Nationally, we're looking at 5%. The Midwest, 5%. Midwest has always done well because of its affordability, its location, and abundance of inventory. The Southeast, 4%, although there are parts of Florida that, have exceeded that. The Southwest has done well at 4%. Um, Texas is kind of the surprising state. It's only been increasing at a nominal 2% per year, which is, you could argue, below the rate of inflation. But so, Northwest and Texas have been kind of on the low end of the spectrum. Southern Florida, Southern California have been on the high end. But anyway, I just wanted to touch on what's going on nationally in terms of price appreciation because sometimes that plays, people are always interested in that anyway, but how it plays into decisions that investors are making when it comes to real estate investing.
Yeah, no, it's good insight. I mean, there's so many different kinds of real estate out there, and I think it's important. I'm curious about commercial. I mean, we've been hearing about commercials, flaming dumpster fire for quite some time, and I know it's still struggling, but I wonder if because I've started to see some deals come through, I don't know, different channels where they look like ridiculously cheap deals. Now, they may not be. There may be a lot of hair on that, but I wonder, like, can you find great deals now? And what would turn the commercial market around?
Well, first of all, I'll be completely honest with you. I don't track the commercial space all that much. From a macro perspective, I can comment on it. Uh, right now, it's interesting when you talk to people about the condition of the economy. Some people say we're in a recession. Other people will say that we're, in a very strong, vibrant economy. I guess it really just depends on what industry you're looking at. Commercial, I can't really comment too much upon it, Kirk. Honestly, I just know that when I drive around, especially in areas that are what I'll call Class B neighborhoods and locations, I see a lot of signs that are in windows saying, for lease, where previous retailers of all kinds and businesses have moved out because they just don't have enough business. Does that mean the consumer is spending less? They're on a budget, they're watching their money more. I think that plays into it. Um, could that be because of high rates of inflation over the last few years, where people's income is increasing at a certain nominal rate, 2, 3, 4, 5% per year, but inflation has been 5, 10, even 15% if you want to measure it in terms of real rates of inflation, not the CPI or what is generally reported. That could be it, but I know that the retail space has been suffering when I travel around the country. But beyond that, I really don't know. I have to just be honest with you.
Okay, no, that's fair. I just figured I'd ask because it's just one of those curious things. I know it's everyone's got their their kind of carve out for their expertise, but um so so here's a question for you. So if I'm thinking about getting into real estate and I'm looking to, you know, I'm looking to get started. It's kind of a weird time because things are in some areas it's fine, but we've seen a lot of run up because of COVID, and it seems like I'm not saying the trends aren't continuing to go, but we've seen a lot of trends maybe overextend because of COVID, people moving to the suburbs, stuff like that, and maybe there's more opportunities. But I know like the city of Boston is a different city now after COVID, so where should people be starting? Like what's the easiest way for people to get started in real estate if they're looking to get in, but it's maybe kind of unsure of where things are going from here.
Well, if you're asking about someone who's looking to invest or maybe continue investing, I refer to it as a top-down approach. You should always start by think of it as a funnel. The top of the funnel is the market, and then you look at the sub-market, then the neighborhoods, and then the properties, and then you build your team around that. But you should always start by selecting, the best, quote unquote, best real estate market that aligns with your investment goals. And a lot of investors start by looking at a property, analyzing property, the condition, the numbers, and all that stuff, with little or no regard to the location. And that's doing it backwards because you can always find deals all around the country. Certain markets, are more well suited for investing than others. But if you're starting with a property, you're looking at properties first, and you're not paying attention to the market, this can be a pretty big mistake. And when I first started investing on a larger scale in real estate, I made many mistakes by choosing the wrong neighborhoods, what I'll call C-class neighborhoods, and it was costly because the turnovers and the expenses that were incurred from those properties in an okay market, but in a poor neighborhood, cost me dearly. And ultimately had to sell those properties because they were costing me money, not making me money. So it's a big mistake if you don't consider the investment in light of the market and the neighborhood that it's in. So the best approach is really to first choose the metro area, the market, and then the city and narrow it down. And that's not a hard thing to do. I mean, you could build a team for yourself, work with property managers and real estate agents or brokers in certain markets to help you navigate that. We do that all the time. That's what our investment counselors are for. But once you've identified a market, you looked at its health, the health of the housing market, the local economy, unemployment, job growth, population growth. Those are major factors for a metro areas is jobs, job growth, population growth, or lack thereof. Then you narrow things down to the best areas and neighborhoods, and you look at things like amenities and schools, crime, renter demand, the numbers. What's the rent to price ratio? If the rent to price ratio isn't high enough, you're not going to cash flow that property, or you're not going to have a strong enough or high enough capitalization rate, because that's going to determine what your rate of return is from a cash flow perspective. But ultimately, when you've done that, now you start looking at the deals that you can find. You start actually looking at properties in the various neighborhoods that meet your investment criteria. So again, I'd call it a top-down approach. Start with the metro area, work your way down, evaluate the property, run the numbers, and once you've identified, the one or two you're going to invest in, now you put it under contract, so you control it. You've locked it down, taken it off the market. Maybe it wasn't on the market ever. It could have been an off-market property. And that's when you continue working with your lender or mortgage broker to get your financing in place. So that way you can close escrow in 30 to 45 days. Meanwhile, while you're doing that, of course, you've done some of your due diligence. You'll continue doing some of your due diligence, but you'll also lock in your property manager so they can step in once you close escrow and take control of the managing of that property. So that way you're not doing it. Unless, of course, you want to do it, that's fine too.
I mean, what do you suggest? I mean, finding good property managers is really, really hard. And of course, managing yourself is really, really hard. So it doesn't have to be, but I think for people who are not equipped for it, it's a struggle. If you're wired for it, it's easy. But
Yeah.
what do you suggest for property management? How should people look at that?
You can do a lot of research online to find property managers that, are what I'll call full service professional management companies, not, mom and pops or a one-man show. Sometimes real estate agents, uh, have kind of a second job, second career of managing property in addition to listing and selling real estate. I I don't recommend that. Fortunately for us, we've been working with various property management companies for so many years in the different markets that we're in that they just come part and parcel with the properties that investors are working with our investment counselors on and purchasing. So they're automatically getting property management attached to the property. They don't have to use that property manager. They could use whoever they want. But if you're looking for a property management company, you definitely want to do your research online to find out the services they provide and don't provide, the fees they charge, what they're willing to cover and not cover, reputation, their reviews. Now, of course, you probably want to knock out the worst of the worst and the best of the best and look at what's in the middle to get kind of a fair assessment of them. But you'll also want to interview them because you're the customer, you're the client. You want to get a sense of how they're going to work with you. Because at the end of the day, you're hiring them. They want, yeah, sure, they want the business, but you want to make sure that they're going to be managing your assets because your properties are exactly that. They're assets. They're not just properties. And then, another kind of frame of mind is look at your tenant as a customer. Your tenant, sure, is a tenant. They're signing a lease and you're providing them housing, ideally, safe, clean, functional housing. But you have to look at them as a customer as well because you're serving them and they're basically buying from you. They're buying or renting the space that you're providing for them. So when you look at your tenant as a customer, it kind of changes how you see and run your business. And then your conversations with your property managers are kind of through that lens of, hey, my customer is the tenant in that property. How are you going to treat them, manage them, serve them? So, but yeah, it involves, some due diligence, online research, conversations, maybe references and even referrals. So it's That's kind of the best answer I can give you if you're doing it on your own. A lot of times they come, referred by a real estate agent or broker or, a firm like ours.
Okay. Yeah, makes sense. All right. Well, as we kind of wrap it up here, what are some final thoughts you can leave our listeners with, given where we are in the world and the opportunities you're seeing? And yeah, what can you leave us with?
Well, if you're new to real estate investing, getting started, or you have a portfolio and you're looking to expand, or even if you're sophisticated and you're wanting to grow your real estate portfolio for various reasons, you got investable income and you want the tax benefits, multiple tax benefits that come along with it, plus the equity growth and the cash flow. Don't wait. The problem with real estate is that it will always be there. There's always demand for it. It's a basic necessity. So it almost doesn't matter when you start or when you continue to grow. There are always deals out there. Again, I get asked the question, should I be investing in real estate? And I said, yeah, whenever you've got the investable capital and you're ready, ready mentally and you're ready to go with your resources, go for it because there's always deals out there. But the sooner you get in, the better off you're going to be long term. You'll always look back 10 years from now, even 5 years from now, you'll always look back and say, man, I wish I bought twice as many properties as what I bought 5 or 10 years ago. The cash flows will increase over a time. The equity will grow over time. The amortization of your loan will go down over time. The tax benefits are always, great to take advantage of. So it's just a matter of being clear on what you want, having the right team to work with, and don't be afraid. Just constantly educate yourself. I'm a big believer in, constantly learning and educating yourself, listening to your podcast, listening to other people's podcasts. That's why I do the passive real estate investing show as well, just to give people education and perspective on anything from strategy, tactics, the economy, etc. Um, but yeah, I mean, that's a long answer to your question. It's just a matter of making the decision, not being afraid and not questioning, overthinking, I guess, whether it's a good time or not. Again, I like to think about it in terms of where, not when. So hopefully that helps.
Yeah, yeah, no, it does. Yeah, thanks. Well, Marco, I always appreciate you coming on the show, sharing your wisdom with us and helping our listeners. Where can people find more about you?
Well, Kirk, thanks for having me on. I really appreciate it. It's always, fun having a conversation like this, especially with you. To find me, I mean, really, our website is kind of the best place to find my team, myself, and all kinds of content. We publish multiple articles a day. So, but that's our website at noradarealestate.com, Norada, noradarealestate.com. That's probably the best place to go. For me personally, just my personal website at marcosantarelli.com. So
Awesome.
that's
Well, once again, thanks for coming on, Marco. Always appreciate it. We'll definitely have you back on the future.
Kirk. Thank you for your time. Have a great weekend. I appreciate it. Thank you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Marco. Always appreciate him coming on the show. Now we're into the panel portion of the show where we have our very own Phil Weiss. Hey, Phil.
Hey Kirk, how are you today? Good to see you.
Yeah, good to see you too. And we have our very own Barb Friedberg. Hey, Barb.
Hi, happy to talk real estate today.
Great. Well, glad to have you both here. So, Phil, what were some of your takeaways from the interview?
One of the things that really jumped out to me was at the end when he had the conversation talking about picking a property manager or managing yourself and like the things to think about and the care that he talked about in terms of selecting a property manager, because that's really important. And then also his thoughts on treating your tenant as if they're a customer and the impact that that could have. I mean, from a general perspective, real estate can be a good way to diversify a portfolio. I don't know that I agreed with everything that he said when he talked about like the impact of mortgage rates. I mean, I understand when he talked about like the idea that it's what the cash flow looks like, but certainly valuations and property becomes more or less manageable based upon what you're paying, and not just in terms of what you're paying for the property, but also in terms of what kind of rates you have, because most of us aren't going out there and purchasing these properties for cash.
Yeah, no, that's a great point. Barb, what are some of your thoughts?
Real estate is a wonderful diversifier. It is not directly correlated with other assets that many of us invest in, such as stocks and bonds. So when the stock market falls, it's nice to have some real estate in your portfolio, either as a real estate investment trust or as owning real estate on your own. That said, real estate is not a passive investment unless you are investing in REITs.
Well, that's a good segue, Barb, because one of the things we want to talk about is real estate versus stock market. Because a lot of people like real estate. Some people are real estate only, and some people are stock market only. But let's kind of compare the two. So, Phil, how would you kind of characterize the difference between investing in real estate versus, stock market, like pros and cons?
So if you really want to be totally passive, the stock market's a lot easier, right? You pick your stocks, the companies you want to invest in, or the indexes you want to invest in, however it is that you want to invest. And you buy and hold those, you make sure you have diversification among different asset classes, and you don't have a lot to do beyond that. Although real estate investing is called passive investing under the tax law, it's not really passive because you own a property, it has to be serviced. If you have a tenant and there's a problem, either you have to fix it or somebody else does. So there's got to be some type of involvement. You can pass that on to somebody else, but if you do that, then that's also going to eat into your profit. So they're different. And there's different types of real estate too. We can think about commercial, we can think about residential, and there's different characteristics to each of those. The commercial market's been really soft for a while, and it looks like that could be changing because a lot of companies are having people go back to the office that were working home. Like, I have a son that works for Amazon Web Services. He's going from 3 days in the office to 5 in January, right? So that's going to potentially have impacts on the commercial market, but there's differences there. But the biggest difference to me is that stock investing is much more passive than real estate investing is.
Yeah, I don't want to ask you, Barb, because you're an old-time real estate expert. And Phil kind of mentioned it, but isn't real estate passive? Everybody says, "Hey, it's passive income. I could just sit around do nothing. And I could buy a bunch of properties." Like, what's wrong with that? Like, why wouldn't people have passive income in real estate versus stock market?
I want to hold off on that question first because I have to talk about stocks versus real estate in terms of returns. And then I'll get into why real estate might not be a passive investment. Stocks, when we're investing, we always want the highest return we can for the level of risk that we're taking, obviously. If we didn't care about risk and we didn't care about return, we'd keep our money in the bank. So there have been a lot of comparisons between the returns of the stock market and the returns of a variety of different types of real estate. And over the long term, for example, from 1928 to 1923, stocks have averaged about 9.8% with reinvested dividends, while real estate has averaged about 4.2% growth. So, according to this research, and then we have more recent data that says that from 1992 to 2024, the S&P 500, the proxy for the stock market, returned about 8.27% or 10.24 with dividends, and real estate grew about 5.5%. Now, I don't know if that takes into account all of the tax benefits that you get from investing in real estate. I don't know about that. It wasn't stated. But if you're just looking for return, that's all you care about, and you don't care about the volatility of your portfolio, the ups and downs, you might want to say, why should I invest in real estate? But most of us do care about that. We don't want to see our portfolio drop 50% when the stock market does. And that's why to include real estate in your portfolio. Now, to your question, is real estate passive? Owning REITs is definitely passive. A real estate investment trust is like a bunch of real estate, either a segment of the market, commercial, storage units, college housing, or a broadly diversified, like a VNQ, which is an overall real estate ETF that owns a whole bunch of real estate and gives you a nice dividend and, pardon me, potential for appreciation. That's passive. Owning real estate under any circumstances is not passive. And that's not a problem if you are willing to understand that and accept that in order to gain the growth, there are so many benefits to owning individual real estate. There are tax benefits galore, and there is cash flow galore. But you have to buy real estate right. In other words, it's unwise, and I agree with a commentator, to buy real estate just for capital appreciation because that is uncertain. So you have to buy it at a price when you tabulate in all of your expenses that you will in fact get some cash flow. And that is not easy to find in Boston, in Maryland, in California, where the three of us are. I'm guessing none of us are going to be able to get a good price on real estate with cash flow. Go to Ohio, go to Michigan. For sure, you can get a bargain and get good cash flow. So my advice is, if you want an opportunity to grow your wealth through real estate, definitely possible. Only passive route is through REITs.
Great. Well, I appreciate that insight, Barb. So, Phil, Barb had mentioned a few things, the cash flow and tax specifically. I know you're a tax guy. So, how does tax play into real estate that people should be thinking about? Is it worth it? Like, how does that all work?
It can be worth it. Again, it depends upon the numbers, but you think about it, you have your rental income, whatever you charge for your monthly rent. If you have a management company, you're going to pay them. You have whatever other expenses are allocated to the property. Some of those expenses you can deduct in the year that you incur them. I think if it's a repair or maintenance. But if you have a bigger expense, like you own a structure that needs a new roof, that becomes depreciable. And it's written off over the depreciable life, which is 27 and a half years, I believe, just like the property. So it's not all deductible in the current year. You can deduct your mortgage interest. You can deduct your real estate taxes and things like that you pay. You do get this depreciation deduction. And that's why, from a cash flow perspective, real estate can work out when the numbers are good because that depreciation deduction gives you an additional offset against your income. So you can end up with a loss from a tax perspective. The only problem is if your income's over a certain level, you can't deduct that loss currently unless you're materially participate in managing the property. So it's not, you might have a loss, but it might be what's called the suspended loss. You report it as a passive loss activity. It goes out on a, gets reported on a specific tax form. You carry that forward. And then if you sell the property at some point in the future, those losses that you couldn't take can be used to offset the gain. The other thing you have to remember, because I have clients that have done this, is if you sell a property, I talked about depreciation. Guess what? If you sell it, you have to recapture that depreciation. So your gain isn't all ordinary income. I mean, it's an all capital gain income. Some of it can be ordinary income. And that makes it more expensive to sell. And then something else I saw a client do, they didn't take the proper depreciation. And this is a little bit of a nuance of the tax law, but the tax law says that the depreciation that you have to claim when you sell the property is the allowed or the allowable amount. So that means if you didn't take the right depreciation when you own the property, let's say you didn't take enough, like people use TurboTax and it sounds great, but it doesn't always work right because it's kind of garbage in, garbage out. If you don't put the right data in, you don't get the right answers. So if you didn't take the right depreciation, if you took too little, when you sell the property, you're supposed to treat it as if you took the right amount the whole way. So you have to be careful in terms of accounting for this. If you own real estate property, I always recommend having a tax professional help you with your tax return. You don't really want to do it yourself because there's lots of things like how do you know which things that you buy are for being expensed versus which you have to depreciate. So there's lots of things to keep in mind. So you have to be careful. But that depreciation deduction, that's what's usually viewed as one of the most attractive aspects of owning real estate because you can end up with positive cash flow without having to report income.
Yeah, that's pretty attractive, I must say. We all like to not report income if we can get away with it legally, of course. Um, so yeah, so let's talk about this. So Barb, we talked about before the show real estate valuations. I think all three of us are thrifty people on this call, and we don't want to overpay for anything we don't have to, especially when it comes to investing. But real estate's been overpriced for a long time, as is the stock market in many views. How should people be looking at buying real estate? Because it's been expensive for a while. So should we just not buy real estate, or how should people be thinking about this?
Both in the stock market and in the real estate market, if you overpay for an asset, then over 100 years, you'll probably come out okay. But over 100 years, you'll also probably be dead. So over, let's say, 5, 10, 15, 20 years, if you overpay for an asset, then it's unlikely that you'll make a profit. So that gets down to learning how to analyze the real estate. So I don't want to spend, the next half hour telling you what to do, but in general, you have to project the projected income. You have to leave room for vacancies because they will happen. So you don't project income based on it's going to be fully rented 100% of the time. Then you have to project the expenses. And you want to be conservative because if you project it at a too low level and then you have to replace the roof, that throws your numbers off. Then you have to treat the mortgage expense, the depreciation, you have to factor all that in. And after you've done all that calculating, then you have to see, is it likely without appreciation over the next, say, 5 to 10 years, if I'm going to have cash flow? But there's another factor to play in, which is the advantage of leverage. Because most of us, when we invest in the stock market, we do not invest on margin. We go long and we invest the money we have. We don't borrow money to invest. If you do, you're investing with leverage. Most of us, on the other hand, with real estate, when we buy real estate, we take out a loan. So in reality, the return you're getting is based on the amount of cash you actually put in, not on the total value of the property. So you buy a property for 500,000, you put in 50,000. If that property appreciates up to $550,000, you've actually made 100% on your $50,000 down payment. So that's another calculation you have to put in. Now, I love this stuff, and it sounds complicated, like everything you do when you're first starting out, and there's a learning curve. But for people that have the interest and the time, real estate can be a wonderful way both to diversify your portfolio and to gain side income.
Yeah, so that's great. So Phil, I want to get your thoughts too on kind of valuations. I mean, everyone's got opinions on this, so I want to get your take as well.
If I think about current valuations, I tend to think that they're high because we've had mortgage rates have gone up, and that normally affects the affordability of any kind of real estate. But yet real estate values haven't fallen, especially in the residential space, while the mortgage rates have gone up. Why? Because if you've got a mortgage at an attractive rate, it's really hard to move because you might borrow less when you move, but your payment's going to go up because of your interest rate going up. So it may not, it's harder to find bargains. I know if I think back to clients that I talked to about potentially buying real estate, when we had rates that were sub 3%, it was really easy to find attractively valued properties that you could rent. You buy it and rent it, but now it's gotten a lot harder because of the fact that rates are higher, and that means that you're going to pay more to own that property. So they talk about the cap rate, which is kind of like a return on your cash and how long it's going to take you to get back your investment. It's more complicated than that, but that's kind of a simple way to think about it. And the cap rates on real estate have gone down in this environment because you're paying a lot more to support that property. So it's harder to find. I do think you have to look in other areas, like Barb said, if you're on one of the coasts, it's probably going to be really hard, especially if you're in California, if you're in the Northeast and the Mid-Atlantic, where property values are pretty high. It's going to be really hard to find something. You're going to need to think about other areas where you might have better chance of success because property values haven't risen as much, just because maybe they can't support the income and the economic characteristics of the region don't support it the same in terms of people that can go and afford it. So you have to think about where you're going. You might have to go someplace different to find something that works for you.
I want to chime in here about different types of real estate because, Phil, you did a good overview of the housing market, but look at commercial real estate today. And you mentioned this with your son going back to work, but in general, I challenge any of you to walk down any major street in any major city, go to the mall, and you will see rampant vacancies because due to COVID, our society has changed. So even though many workers are being implored to go back to the office, there are still a lot of people working from home and really resistant to giving that up. Also, we are shopping online like never before, again, initiated by COVID. What does that mean for retail brick and mortar stores? It's harder to maintain a store. So you'll see a lot more vacancies in malls. You'll see a lot more vacancies in commercial real estate. And we're kind of at a pivot point. So what's going to happen to that? I think it's unless you get a super good price, I'd be hesitant to invest in most commercial real estate. Now, data centers, that's a whole different story. We're using a ton of data. That might be a good growth area. There are other niches that are good, but the commercial office space is a really difficult place to be today.
Yeah, no, I agree. I think it's a tough area, but that's where the bargains are found is when things are tough. And if you're um, persistent and diligent enough, you could probably find them now.
That's a really good point, too. And actually, I know in the San Francisco area where I live, a lot of the commercial space is being turned into housing where there is a huge demand. And if you are investing with, say, a bigger company that's doing that, buying up commercial space and turning it into housing, there might be some profit potential. But also, I want to throw something else out because a lot of people, a lot of very smart people, offer real estate investment opportunities. Most of the time, you have to be an accredited investor, which means you have to have a certain net worth or income or be knowledgeable in the investment field. But they will kind of offer a DIY solution where they buy up these properties and you can buy shares in them. On the surface, that sounds very good, but I implore all of you before going into any type of situation like that, look at the expenses you will be paying, look at the background of the managers that you are quote unquote hiring before you dive into those types of offers.
Yeah, no, I appreciate that. So, one last question, we'll wrap it up here, is property management is obviously a big part of this. And it's always a struggle finding a good property manager. What's your kind of what are your thoughts on that, Phil? Because obviously you can't be passive unless you have someone else doing it for you. What are your thoughts on property managers?
I like what Marco talked about there, the fact that go and talk to them, interview them. Don't just hire somebody because you found them on the internet. Because you don't want, if you're hiring a property manager, that means that you don't want to be the one that they call at 2 o'clock in the morning when a pipe bursts, right? So you want to make sure that you get someone that you're confident in that can take care of that property, that can do the things that need to be done, and that you want to be comfortable with what you're paying them, right? But you want to make sure that don't try to be too cheap, because if you're too cheap, you're probably not going to get good service. But that's kind of, to me, the hardest part about real estate investing is deciding how you're going to deal with that property management issue. Is it something you want to do yourself, or is it something you want to outsource? I know it from personal experience. I saw that my father-in-law, he was in real estate. He sold properties. And every time he sold properties, he would get a unit. Like they would go to townhome or condo builders, and he would get a unit as part of his compensation. And he liked to take care of them. He was his own property manager. And then when he passed, my mother-in-law got the properties, and two of my brother-in-laws were responsible for taking care of all of them. After she passed, they sold every property because they didn't want to do it anymore, and they didn't like the economics of hiring the manager, and they just said it wasn't something they wanted to do. So you have to make sure that if you're going to do this, that you do it the right way, because either it's going to cost you, you don't want to overpay, but you don't want to underpay, and you also don't want to get those calls in the middle of the night. So you need to be prepared. It's something you really have to pay a lot of attention to when you do it.
Hiring a property manager is not passive either because you have to manage the manager. So you have to make sure they're giving you the value that you paid for and that they're handling things because we've had situations where there have been problems with a property manager and the property manager doesn't handle them. And you might not even know it because the tenants are calling the property manager, not you. And so it might be less work to have a property manager, but it's not no work.
Great. Well, as we kind of wrap it up here, Phil, final thoughts from you.
Sure. So the one thing I'd like to say, I'm going to kind of go back a little bit, is real estate investing is just like any other type of investing to me in terms of be a contrarian. Like we talked about a little bit about commercial real estate. That's where the bargains might be right now. It's going to be harder to find bargains in retail. So if you're going to invest in real estate, just like when you're investing in the market, look for undervalued assets. Be a contrarian. Don't always look for whatever's the latest and greatest or the hottest thing. You know? As for me, I know that experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you're facing new beginnings, you can take our Flourish Through Life's Big Changes assessment at apprisewealth.com/assessment to discover how ready you are to embrace and thrive through your significant life transitions. You can also sign up for our blog. Thanks for having me today, Kirk.
Yeah, thanks for coming on, Phil. And Barb, final thoughts from you.
I love real estate. I really do. I grew up with it. My family's was in real estate, and I've owned real estate. I've managed real estate. Um, so I think it's a really important asset class. And I believe, look, even if you don't own a REIT or a rental property on your own, you probably own some real estate if you own a diversified stock fund. But if you want a little more exposure, don't want to do the work, invest in a REIT or two, a totally diversified REIT, or go into a sector REIT, like I mentioned, you know, um, data storage or maybe warehouses or something like that, where there is a growing demand. And you will get some cash flow and the chance of appreciation. On the other hand, if you are motivated, excited, and interested in this area, you can learn about investing in real estate. You don't have to have a ton of money. I do not believe in no money down. I think you should have some money, but it is an area that is ripe for investment. You just have to find the places where the valuations work. I'm Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance and on YouTube.
Great. Thanks for coming on, Barb. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.